Yes, there are downsides to even the VA loan, or at least things that you need to seriously consider before you use your entitlement. So we're going to talk about those today, as well as some of the coolest aspects of the VA loan, which I consider to be the most powerful and unique loan product available today. Okay, so I'm the kind of guy where if you ask me, do I want the good news or the bad news, I'm always going to ask for the bad news first. Okay, that's just how I am. So we're actually going to start with the cons before we get to the good stuff, okay? So here's number one. The VA funding fee. Too many people are unfamiliar with this and how it affects them. So the funding fee is a surcharge for every time you use your VA loan. The first time you use your VA loan, that funding fee will be 2.15% of the loan amount. Now, you don't pay that up front. It actually gets baked into your loan. So when you look at your loan documents, the loan amount will always be this weird number that's just a bit more than your purchase price. That's because it's the purchase price plus your VA funding fee. Now, on the first time, it's 2.15%, but on any subsequent usage, it goes up to 3.3%. Okay, so it's always something to consider when you're shopping. You got to factor this in because it, of course, affects your loan amount, your monthly payment, total interest paid, everything. Now, there are ways to reduce that funding fee or get an exemption altogether. So a reduction really comes down to down payment. Now, we know that you don't have to put money down with your VA loan, but if you do, you can reduce that funding fee to 1.5% or even down to 1.25%. Also, there is a full exemption available. Now, how do we do that? Purple Heart, or a VA disability rating of 10% or more. If you fit into either of these criteria, that funding fee is totally exempted, off the board, zeroed out. You don't have to worry about it. Pretty cool. Okay, next up. If you do have to pay the VA funding fee, then you are technically going to be starting your loan term upside down on market value. And this is what I mean. You go out, purchase a home for $300,000, an appraisal gets done, right? Comes in at $300,000. That is the market value, okay? That's what someone was willing to pay, and that's what the appraisal said it's worth. Now, because of your VA funding fee, your loan amount is actually going to be closer to $307,000. So for all intents and purposes, you're $7,000 upside down on that loan, which is why if you're going to buy a home and try to sell it in a year or 18 months, the VA loan is not the one for you, okay? Because you got to chew away at that funding fee before you ever even get back down to market value. So the VA loan is really only good if you're going to be holding on to that home for 3, 4, 5+ years, or if you're in an environment where the rate of appreciation on homes is really high, i.e. 2019, 2020, 2021. Okay? If it's a market like it is now and you try to sell that home 12 months later, it's not going to go very well for you. Okay? All right, VA loan is designed to be used for the purchase of a primary residence only. So you cannot purchase a home with your VA loan with the intent to rent it out, produce income, make money, become a landlord, any of that. Okay, now, I know what you're thinking, but Mike, you're always talking about, building wealth with your VA loan. Yes, I am. Okay, if you meet the occupancy requirement set forth by the VA, which is 12 months, and then you turn the home into a rental, the VA will have nothing to say. Okay, but you have to show the intent to occupy as a primary residence. The VA loan is not meant for you to simply accrue investment properties. Okay. Depending on where you're at in the United States, the VA loan can get a very bad rap. Now, if you're anywhere close to a military base, don't worry about it. Because VA loans are such a huge portion of the market. All the real estate agents are familiar with them. But there are certain portions of the country where I hear a lot of stories that real estate agents will not accept VA loans. But why? It's backed by the federal government. It's a reward for our veterans and service members for their service, their dedication to their country. Why the would an agent not accept it? Well, it's because they have really bad ideas about what it is. They think it's for poor people, people with terrible credit, people that don't have any money. Basically the bottom of the barrel buyer, which is frankly not true. I mean, I do VA loans for over $1 million every month for FICOs at 800, people with $200,000 or $300,000 in the bank. Like, the VA loan is not specified to any kind of buyer, any grade of buyer. It's for anybody that met the service requirements. It's their reward. Okay. Now, if you're in a place where you're getting pushback on your entitlement, it's really the lender that needs to call whatever agent's giving you problems and give them some damn education. And I've done it plenty of times. Okay. Because it pisses me off. And what I tell them is, like, the FHA loan is, strictly speaking, for these buyers you're talking about, poor credit score, low cash, things like that. The VA loan is actually one of the strongest loan products there is. And again, it is backed partially by the federal government. Okay, so a lot of agents just need the education. Again, if you're getting pushback, reach out to a lender, reach out to me. I'll make the call. I'll let them know what's up. But again, this is only in certain part of the countries. And I think as more time goes by and more VA buyers are out there, this will kind of slowly dissipate and go away. So, okay, these are our cons, right? So funding fee, and it could be reduced, it could be exempted, but just keep it in mind. You're going to start out upside down on market value if you go fully financed with the funding fee. You have to occupy this home as a primary residence. Don't play games with that. That's mortgage fraud. And VA loan can, in certain areas, certain parts of the country, get a bad rap because people just are not educated on it. Now, let's move to the good stuff. Okay, we're going to go to the pros. All right, everybody knows this one, but I'm still going to put it on there. No down payment. So if you're unfamiliar with buying homes, I'll put some context on it. Down payment minimum for FHA is 3.5%. Minimum down payment for most conventional is 5%. There's a few programs that are 1% and 3%. But clearly, this is a sizable difference for cash out of pocket to get inside of a home for FHA and conventional versus VA. Okay, now, you can put money down, and there's scenarios where it is advantageous to put money down, but you have the flexibility not to do it. I do loans every month where, VA buyer, minimal money is coming out of their pocket to get into the home. Okay, so maybe that's something you can take advantage of as well. PMI. This stands for Private Mortgage Insurance. Now, this is the penalty that civilians pay for not putting down enough. So on FHA, you have PMI regardless. On conventional, if you don't put down 20%, you get PMI. And this is just an extra payment layered into your monthly mortgage. So you're doing, your principal interest, your property taxes, your homeowner's insurance, and then you got PMI in there as well. And it's based off of the loan amount and credit score and all that, but it could be $70 or $300. Okay. So this is another expense affecting monthly payment that you as a VA buyer do not need to worry about. Better interest rates. Now, this comes from the fact that it is a government-backed loan. Okay, so VA and FHA and USDA have better interest rates than your standard conventional loan. How much better really depends on the day, as well as the buyer profile, but the general rule is about 0.5%, maybe 0.75%. So it's pretty sizable difference. Now, we all know, as it stands right now, interest rates are kind of high across the board, but I'd rather be at 6.25 or 6.5 than 7.25. Wouldn't you? This is a big one. Softer guidelines. And what I mean by that is the baseline for approval is a lot looser than with the other loan programs. Example, for a conventional loan, the minimum credit score is 620. Okay? For FHA, 3.5% down, the minimum credit score is 580. But guess what? The VA does not even have a minimum credit score. They actually kick that can down to lenders to determine their own threshold. So if you go to, Veterans United, they'll tell you 620. I think Rocket Mortgage is 640. Mike Lindsay, can go down to 500 on VA. So we get a lot of borrowers through the pipe that could not qualify on other loan programs or even with other lenders. Here's another one. Debt to income percentage, okay? Conventional loans had a hard cap of 49.99%. All right? FHA can go to 56%. There is no real cap on VA because they actually go by a different calculation called residual income. We've run VA into the 60s, if it made sense. Now, I will caveat that by saying, just because you can do it, doesn't mean you should. And in some of these situations where we ran it up into the 60s, there was some compensating factors, namely a spouse or significant other that was not on the loan but had income, But the point is, again, you could get borrowers through the pipe on VA that you could not otherwise do with other loan products. So, softer guideline, they really, really want you to use this loan product. So if you've been paying your bills, you got steady employment, you got a little bit of money in the bank, odds are you can qualify to use your entitlement. Wow. No prepayment penalty. What does this mean? Essentially, you buy your home with your VA loan entitlement. About 8 months later, you win the lottery and you want to pay off your home. You can do that. And there's no penalty for doing that. Believe it or not, with certain other loan products, right? They don't want you paying this thing off early because they don't make money. So if you do, there's a surcharge for doing that, or they just won't allow you to do it. Not the case with VA, okay? You can pay this loan off as early as you want and not have to worry about suffering any kind of monetary penalty. Assumable. Big topic of discussion right now, and we're going to do some videos on this topic at a later date, but a VA loan is assumable, meaning that if you have a solid or aggressively good interest rate, another VA buyer could step in and take over your loan as it is, meaning inherit your interest rate, inherit your loan balance, inherit what's left in the term, everything. Conversely, you could go out there and find a VA seller that's got a nice 2-3% interest rate and step into their loan. Now, there's a lot that goes into it. It's not quite as easy as what I just said, but the option is out there. Now, if you're buying right now, nobody's going to want to assume 6%, but let's say, 12 months, 18 months from now, rates are at 4.5%, you buy a home, rates go back up. That 4.5% is going to be looking very advantageous to potential buyers. Refinance options. So there's two primary ways to refinance a VA loan. Number one is called an IRRL, an interest rate reduction refinance loan. It's a streamlined refinance. You really should only have to turn in a mortgage statement to your lender. All the VA is looking for is tangible benefit, right? To make sure that, you're not spending money to refinance to save $14 a month. So it's a reduction in interest rate, maybe debt consolidation, shortening the term, whatever. It's very, very easy to do. And you're available to do it after 6 on-time payments or 210 days from the original closing date. Too easy. The other option is the VA cash out. So this is where you can draw out the equity of the home. And VA actually will allow you, under certain circumstances, to do a 100% cash out. So pulling out all the equity that you have to do some home upgrades, to maybe go buy another house, whatever. Now, again, just because you can do it doesn't mean you should. All right? Screwing around with your equity is a big deal. So do not do that, whether it's a cash out, HELOC, whatever. Do not do that without really considering all your options, talking to lenders, talking to experienced people who have done this kind of stuff before. Okay, so I got this one underlined because there might be more misconceptions about this than any other thing that I've itemized here. So the VA loan is a lifetime benefit. Yes, you can use it more than once. In fact, you can use it as many times as you want. And not only that, I say it's a lifetime benefit, but it could actually survive you because you can pass your VA entitlement on to your surviving spouse. I meet so many people who think that they can only use their VA loan one time, so they're just waiting for the perfect opportunity. Oh, no. I think I've used mine 4 times now. I've met people who've used it 5, 6, 7 times. you are going to carry this thing around with you for the rest of your life. All you got to do is stay within the left and right limits of the entitlement, which means you need to get educated on the entitlement so you know what that means. But don't feel like you're just going to use it up and then be stuck for the rest of your life. It's not like that at all. Okay, so these are the cons and some pros of the VA loan entitlement. If you want to talk any of these in more detail, or if you have questions about some other aspect of the loan product, please reach out to me. This is what I do all day. Okay, I'm on calls, Zooms, texting, emailing, educating service members and veterans on this entitlement because no one else does it for us. So please reach out. We can schedule a call to go over any of these items or anything else with the VA loan.